Is book value a good way to value a company? Imagine trying to figure out what a business is really worth just by looking at its balance sheet. That's what book value is all about. It's a simple calculation, total assets minus total liabilities. It shows what the company owns minus what it owes, giving a snapshot of its net asset value. This figure is based on accounting records, so it's stable and updated usually once a quarter or once a year. Think of it as a baseline or a floor value, especially useful if the company were to liquidate. If you see a stock trading below its book value, it might be a sign that the market sees it as undervalued or perhaps distressed. On the flip side, if the market price is higher than the book value, investors might be betting on future growth, or the company might have valuable intangible assets like brand names or patents that aren't reflected on the balance sheet. But here's the catch. Book value doesn't include things like brand value, intellectual property, or goodwill, which can be huge drivers of a company's worth. It's based on historical costs, so it might not reflect current market conditions or the true cost to replace assets today. It also ignores future earnings potential, growth prospects, and investor sentiment, all of which are key for stock prices and options. Plus, accounting policies like depreciation or asset write-downs can distort the actual value. When it comes to trading stocks or options, most traders and investors look at market value and future expectations. Options prices depend heavily on volatility and anticipated price moves, not just static numbers like book value. That's why many investors combine book value with other measures like price-to-earnings ratios, discounted cash flow analysis, or market capitalization. For example, a low price-to-book ratio might suggest a stock is undervalued, but you need to consider other factors like industry trends or company health. In the end, book value can be a helpful starting point, especially for conservative investors or during liquidation scenarios. But it's not enough on its own to fully value a company, especially for stock trading and options strategies. You want to look at a mix of valuation methods that include market expectations and future growth potential. Using only book value might lead you to overlook important intangible assets or future earnings, which are often what drive stock prices and options premiums. So, always think of it as one piece of the puzzle, not the whole picture.